Dear students, just hold on for a second. Okay, so dear students, I welcome you all in today's live session, day 5 of our AAA exam focused revision series. We were discussing question number 1 in yesterday's session from December 2022 attempt. And I hope that you have also tried it at your home. So, can you please confirm me that have you tried it on your own or not? Please do let me know. Anyone who has actually attempted any risk, who have actually attempted the question, and anyone who would like to show me if he or she has drafted any risk or any procedure. Any student. Okay, but let me make this very clear to you that until and unless you yourself actually attempt these questions on your own, until and unless you get hands-on practice on few past exam papers, and in the beginning of the session, I told you you should have done at least 3 simulations before your final exams. Okay, so I hope that you will practice on your own as well. But I want to share few elements of solution with you, which I hope is on your screen. Can you please confirm me? Can you confirm me, everyone? Dear students, can you please confirm me that can you see my screen and the suggested solution? Perfect. Okay. So one very important thing that when you are drafting the answer, you should follow the format of briefing notes, which you know very well. To whom you are addressing the briefing notes heading, first of all. Then to whom? Ted Hastings, audit engagement partner, from audit manager, subject 𝗦𝗲𝘀𝗀𝗀𝗀, audit planning, date, and then the heading introduction. Now, this format contains few very important marks for communication. Are you getting this? This contains some very important marks for communication. The professional skill marks. Okay. Then you have to write this introductory para, and this is more or less a standard sort of para. These notes are prepared, and why you are preparing these notes, you simply have to communicate the objective which have been given to you in the partner's email. So whatever the partner has asked you, you have to simply write it in the introduction para. These notes are prepared to assist in the planning of audit using the information provided by the company's finance director, the business risk facing the company, significant risk of material misstatement, I have prioritized and explained in this report. In addition, the notes discuss the impact of outsourcing and finally the principal audit procedures. So basically speaking, whatever has been asked and requested by a partner in his email, whatever has been asked by the partner in his email, you have to simply reproduce it in the introductory para. So is this crystal clear to everyone? So there are 4 marks for communication, and those 4 marks can be scored if you opt the proper briefing notes format, if you put the introductory para, okay, if you structure your answer, professional structuring of your answer, sequence of your answer. Okay. Just like this, business risks, you will have to mention business risks, then all the risks of material misstatements in the same fashion, which we were discussing yesterday. And then the 4th mark is for the clarity of expression. Now, the clarity of expression is very important. And obviously, that comes through practice. So 3 out of 4 marks, 3 out of 4 marks of professional communication are easy. Format of the briefing notes, introduction, structure of your answer. These 3 are easy points to gain. 4th one, you have to practice a lot for it. Clarity of expression, which is again not a difficult thing. So 20 out of 4 marks secured. Are you getting this? Now see, business risks, we've already discussed how to identify the business risks and how to draft the business risks. Okay, so you can go through these business risks on your own. We've already discussed it. One thing which I would like to focus is when you start risk of material misstatement, you have to you have to calculate the materiality and you have to explain the materiality. Okay. And I have already explained it to you yesterday, but we are now just having a look at this, that how you are going to prepare or how you're going to attempt it in the examination. For the purpose of briefing notes, the following overall materiality has been used, which is based on the profitability as per your instructions. Okay. 5 to 10% of PBT, so range is 3 to 6 million. Now you have to justify whether you are opting 3 million, whether you're opting 6 million, or whether you're opting a mid range of 4.5. So I've already discussed this, but I'm simply reading this for your convenience. These benchmarks are only a starting point for determining materiality. And so these are the standard wordings. So just read it twice or thrice, and you'll have this in your mind. So these are the standard wordings, standard 2 lines which you have to reproduce. Now, the rest will be based on your understanding. Although 𝗦𝗲𝘀𝗀𝗀𝗀𝗀 is an existing client, the company is listed and taken out new loans. Okay. Significantly increasing the level of scrutiny from outside investors. Therefore, since the last financials and therefore due to the increased detection risk, our detection risk is increasing. Okay. Purchase of property, changes in business risk, purchase of properties. Since there have been changes, so detection risk increases. So it's better to keep the materiality at the lower level, which is 3 million. Okay. So if the risk is higher, we will opt for the lower element of the range. Okay. And the rest we already discussed, and you can read it on your own. You have to keep the pattern similar. Although the content given in the suggested answers is a bit on higher side, but you have to be focused and on target, because if you are drafting properly, correctly, then no matter suggested solutions give you a hell lot of information. These suggested solutions are designed keeping in view the maximum possible pointers. Even this is the suggested solution, not for 100 marks. This suggested solution is of might be 130, 140, 150 marks. But our first target is to pass this examination. Okay, so don't get driven away with the long answers, to the point, specific, right on target. Okay. Okay. So this is it. Uh, and the next, I would want you people to have a look at this question. Question number 3 from December 2022 attempt. Question number 3 from December 2022 attempt. Okay. So you are reading it and you are planning it. See what is there in this question. There is an exhibit given and there are two issues. One is for leases and one is for inventory. So these types of questions, again, I assume are marks gaining questions. If you have the grip on the relevant accounting standard, then by reading the content, by reading the text of the question, by reading the requirement, I believe you can easily identify the pain points or the problems which are contained in the question, the non compliances, the problems. This is not a big deal. You can do this. Are you getting this? Provided that you can recall the requirements of the relevant standard. So, simply what you have to do, you have to read the content wherever you feel that this information is problematic. This is some error, this is a misstatement, this is some fishy information, highlight it and plan it. What is the non-compliance? What is the non-compliance? What is the problem in this information? Make the plan pointers. Keep the same approach. Which areas under the risk? We know leases. What is the accounting requirements, applicable accounting requirements? What has been done wrong here, and how we have to apply that requirement? Materiality, is the figure above materiality? Uh, misstatement, misstatement is above materiality. Then whether the management is willing to rectify it or not. If the management is willing to rectify it or not, if management is not willing to rectify, then what will be its impact on the report? Is it a misstatement or a lack of evidence? Is it material only or pervasive? Or does the information require any additional paragraph? Okay. So reporting question contain these considerations, I believe, which is not a very difficult task to handle. Now, this question is in front of you. So you are reading this question. I'm allowing you 5 to 10 minutes to go through this question. Use your heads, use your brains, get the engine started, get it heated up, and then try to plan it on your own. Okay. So you are planning this question, and we will be resuming in a while. Meanwhile, you use your heads and brains and start thinking on the question. And you have to assume that this is the examination scenario and you are given with the question and you have to attempt it. So now, please plan it. It's up to you now. Okay, so dear students, welcome back. I hope you have read this question and you have tried to make some pointers. So, can anyone please confirm me that have you made some? Anyone? Burton, great. So, I'm starting reading this question. So, please match whether your drafted or planned pointers are on target or not. Okay. The question is a typical exam type question, completion, audit, and review, and reporting type question. And whenever such question comes up, matters and evidence question comes up, matters and evidence. You should promptly recall this technique. 1 mark for every matter explained. Identify the relevant accounting rules, apply to the scenario, calculate and assess materiality. If the client has done materially wrong, assess the impact on the audit report, and comment whether sufficient appropriate audit evidence has been obtained. Okay. If you can keep track of these pointers, then you might not be missing any key information to be mentioned in your answers. Okay. Now let's read it. And you know how to plan. Word processor should be on. This should be here side by side. Okay. It should be here side by side. Word processor should be here side by side. Okay, let us read the question first. Requirement. First of all, read the requirement always. Evaluate the matters to be considered on completion of the audit and audit evidence you should expect in your audit working paper file. Okay. There are two matters, leases and inventories. Okay. So for leases, there are 9 marks. For inventory, there are 7 marks. It means that if for leases, if you identify 4 matters to be considered, 5 procedures, that's also enough. If you identify 5 matters to consider, 4 procedures, that enough to get you 9 marks. In inventory, if you identify 3 matters to be considered and 4 procedures, that's enough. Are you getting this? And then evaluate the implication of the auditor's report, assuming the inventory matter has been satisfactorily resolved, but that no further adjustment of disclosure is made to the financials with respect to property lease. That means the inventory matter has been resolved, so there is no dispute for that. But if the lease problem remains unresolved, will that have an impact on the audit report or not? That's the question. Okay. Perfectly fine. And now we are starting reading the question. It is 1st of July 2005. Okay. So in completion question, you will notice that the date of assessment, the date of analysis, that means if we are analyzing on 1st of July 2005, the year end is 31st of March 2005. Okay. You are the manager responsible for audit of Marlowe's Co. and you are completing the audit of financial statements for the year ended 31st March 2005. Marlowe's Co. is a listed company operating in the retail industry. The audit field work is nearly complete and the auditor's report is due to be issued in 4 weeks. It means completion phase. The following exhibit available on the left-hand side of the screen provides info relevant to the question. Audit matters. Summary of key matters. Audit supervisor has flagged for your attention. A. Evaluate the matters to, sorry, opened the wrong exhibit. Okay. The draft financial statements. The draft financial statements recognize a total asset of $118 million and PBT of $11.5 million. Materiality has been set at $1.1 million. That means if the misstatement is above this level, at or above this level, that means it will be problematic or it will be a concern for us. Are you getting this? It will be a concern for us. Okay. So it has been made easier for you. You have been given materiality. Examiner alternatively can prescribe you the benchmark, can give you profit figure, and can say the materiality is based on profits. So now the examiner usually gives the materiality threshold. Okay. New property lease. Marlowe's Co. expanded operations during the year and as part of this process arranged on 1st April 2004 a new property lease. Okay. So a new property lease has been arranged as part of their expanding operations. The lease contract is for 7 years. Okay, so the lease start date is 1st of April 2004. Might be it could be useful. The lease contract is for 7 years with a rent-free period of 12 months followed by 6 annual rental payments. The contract meets the IFRS 16 leases criteria to be classified as lease. The financial statements recognize the right to use of asset, $28.9 million, and a corresponding liability of the same amount, which has been correctly calculated at the effective interest rate implicit in the lease agreement. Perfectly fine. So, having read the para till now, in this para, nothing is problematic. We have been given some information. Until now, nothing is problematic. Yes, one information is hinting us that there could be some problem awaiting in the second para. The lease is for 7 years with a rent-free period of 12 months, followed by 6 annual rental payments. So basically, first year is the rent-free period, and then we have 6 payments. But obviously, since the lease has started, so have we got the asset? Yes. Have we started using the asset? Yes. Have we got control of the asset? Yes. Don't you think that the asset should be recognized? Obviously, yes. Moving on. Management has not charged any depreciation on the right of use of asset. See, this is the problem statement. Stating that the rent-free period should not result in an expense being included in the statement of profit or loss. So you will always see in such type of questions that the problem will be spoon-fed by the examiner. Examiner is spoon feeding you the problem. See, this is the problem. Look, this is the problem. And you simply have to take these golden eggs in your basket and gain easy marks. Okay. Again, this is a wrong statement. So we should be. So what is our duty? What should be our duty? We should explain proper treatment of leases. Requirements of lease recognition. Lease liability, right to use asset, which amounts included, which amounts are excluded from these figures. Complete treatment. So this can be done better by a student who has a grip over the accounting standards. Okay. Management proposes to begin depreciating the right of use in the next financial period and the depreciate asset over the 6 years for which they make payments. The finance cost in relation to lease liability has been correctly accounted for in the financial statements. Okay. So basically, what are we required to do? We are required to mention the requirements of IFRS 16. Okay. How a lease is recognized, what amounts are recognized. Okay. There's the date of commencement of lease, the date of commencement of lease. So I'm explaining to you, okay, I'm not writing everything. It will save time as well. And the discussion, you have to keep this in your mind. So whenever there's an arrangement of right to use of an asset against periodic payments, this arrangement is a lease. And whenever there is a lease arrangement, the lessee is required to recognize the right to use of asset as well as the lease liability. Now, talking about the right to use of asset. Right to use of asset. First of all, okay, let us discuss first of all lease liability. So obviously, we are required to make the payments under the lease arrangement. Yes. For example, we have paid an amount at the commencement of lease. So obviously, if at the commencement of lease any amount has been paid, it will not be made part of liability because it's no more liability and you have paid it. But whatever you have paid will obviously go to the asset. So the asset or right to use of asset will be debited. An amount paid, that means cash or bank will be credited. So this amount will not go in liability, but yes, this will be debited to the asset. Whereas the remaining liability will be recognized as a liability, that too at present value. So we'll be calculating the present value and we'll recognize the liability, the corresponding debit to right to use of asset. Very simple. Okay. And the right to use of asset may contain any directly attributable costs which have been incurred, any dismantling costs, whatever the case is, right to use of assets. Okay. Once the lease has been recognized, with the passage of time, every year as we move on, we will depreciate the asset on the useful life or the lease term, whichever is lower. And we'll keep on recognizing the expense in the P&L. So I hope these requirements are clear in your mind. So you, as a student, will try to mention the requirements of the leases. Now, what the management has done, management is saying, okay, then you have to comment on the contention of the manager that since the right to use of asset has been created on day one and the asset is in use since day one, therefore the asset will be depreciated as per the requirements of say IAS 16. Are you getting this? So no matter there is a rent-free period, but the rent-free period has only something to do with the payment terms. And payment terms will not impact the usage of the pattern of the asset, which is depreciation. Are you getting this? So depreciation will be booked right from the beginning. And if the asset is of $28.9 million, then $28.9 million will be depreciated over 7 years. Okay. And if we calculate 28.9 divided by 7, it's 4.12. And it's way above the materiality of 1.1. So if this amount is not adjusted, if this amount is not rectified, if this depreciation expense is not recognized, then what will happen? It will have an impact on the audit report. So we will request management, please rectify this. Okay. So in the planning, requirement of 5 IAS 16, comment on non-compliance in light of the above requirements and IAS 16 and treatment if management fails to rectify materiality. Then we know it's material. Are you getting this? And treatment, if this is part B, but we know if management fails to rectify, what will happen? We have to qualify it on the basis of material misstatement or lack of evidence. Material misstatement. We have the evidence and we are sure that this is the problem. Okay. Material misstatement. Is it material only or pervasive? You will say it is material only as the effects are limited with the least recognition elements. That is leased asset and its corresponding liability. So it's not pervasive, it's not rubbishing the entire financial statements. It's material only. So what we'll do? Opinion qualified on the basis of material misstatement. And then there are easy marks to write this sentence that will give the hearing qualified opinion. And we will explain that our opinion is qualified in respect of this wrong treatment. And then this will be followed. Basis of opinion. This will follow by the basis of opinion para, in which we will be explaining the qualification with its impacts. That's it. BOQ para means basis of qualification para. Okay. Very simple. But this opinion matter has been asked in requirement B, but I have discussed with you at this moment. Then there is a part that what evidence is. So whenever evidence is being asked, this is not a big deal. You simply have to think. Think. There's the lease arrangement. What could be the evidence? First and foremost evidence is the lease arrangement, lease agreement. What is the arrangement? Terms, underlying asset, amounts involved, rent-free period, blah, 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 to assess the reasonableness of the treatment and the recognition of lease. Then you can take the breakup schedule calculation and have it recalculated to assess its accuracy. Two very easy processes and procedures done. Are you getting this? Whether they've received the asset, just go and inspect the asset. If they've received the asset before the rent-free period and they're using it in the business. Are you getting this? So there are a few very, very easy procedures for which inquiry with the management. But why have they opted that treatment? Aren't they using the asset in their business? Because the asset should have been used. Asset should be depreciated. Inquiries with the management, discussion with the management. Are you getting this? So this question is straightforward. This question has nothing very complex or technical elements. The next part is inventory. Marvelous Co. has recently negotiated arrangements with the new supplier, including the contract is the clause which allows the supplier to require the return of products at any time. Marvelous Co. can also return the products within the set period of time if they remain unsold. Okay, so supplier can take the products back. Marlos can also return those products to the supplier. That simply means that whatever products have been kept with Marlos, they don't have any right over those. Okay. So these are not even their inventory. The supplier can pick that up whenever they wish to. Okay. So inventory purchase from the new supplier with the value of $8.1 million, obviously, which is very material, is included in the company's financial statements as inventory at 31st March. So this is wrong. If you talk about the inventory element, then this is consignment stock. This is not their stock. This is not owned by the company. Are you getting this? Not owned by the company. Supplier can pick that stock back. Cannot be recognized until purchased. Okay, let's see what happens further. These amounts are recognized at cost, which is lower than the net realizable value of the products. Okay. And when this is actually purchased, when they actually sell it to an onwards customer, then they have the right. They receive the right and they dispose the inventory. So in actual, even then, they're not supposed to record the inventory. Because as soon as they have the right to record it, they are selling it until actually purchased. And when they'll purchase, in the event of sale. So, for IFRS 15, So should these inventory be recorded? They simply have the receivable from the supplier. Supplier will take the inventory back and give them the money. They're simply holding on behalf of the supplier. That's it. This is trade receivable. And this is the reclassification adjustment. It shouldn't be recognized as inventory, rather, it should be recognized as a trade receivable. This is just a classification problem. Okay. And it has already been told in the question that this problem is solved. So, no impact on opinion. But what could be the procedures? Have the arrangement with the supplier. What are the terms? When the title passes to the company, when the title passes, when the risk and reward passes to the company. What are the terms? What are the conditions? Are you getting this? Plus, plus. After that, whatever the inventory they have the inventory records verified, the amount verified, which is kept at the premises. Go and get it physically inspected. Getting this? Have the confirmation from the vendor about the amount involved. Easy procedures. Have the director's representation, management representation. So procedure writing 3, 4 procedures is not a big deal. Just recall those two checklists, AEIOU, SAT 3. That's it. Subsequent to year end, see which receipts have been received or paid to the supplier. Dear students, are you getting that whenever these types of questions come in, impact on audit report, impact on audit report, they're not a big deal. If you have any questions, if you have any concerns, please let me know, or we should move on to the next question. And you can see the suggested solution as well. I hope that you might be having it, and I will provide you as well. So whatever we have discussed, and yeah, keep this in mind that since this is an evidence, so copy of lease, evidence of the physical inspection, recalculation, copy of proposed financial disclosures, okay? Copy of inventory record, copy of obtain confirmation, see the copy of contract. So you should use the terminologies, the verbs, the in the sentences likewise, as if you are obtaining evidence. Are you getting this? So, dear students, is this crystal clear to all of you? Everyone? Please confirm me so that we can move on to the next question. Okay. The next question we'll be looking at is from September 2022 attempt. Quinn's Co. Okay. 𝗏𝗏𝐻𝗃. We'll be looking at the question, audit risk question from September 2022 attempt. 𝗏𝗏𝐻𝗃. Okay. So what I would request. Okay. So a good question. So you are having a look at 𝗏𝗏𝐻𝗃 and you are having 15 minutes. 15 minutes to plan this. See the requirements in the partner's email. You are actually planning it. You are having 15 minutes and you are having these 15 minutes to plan this answer. You just have to plan it. Which business risk? Make the pointers. Explain the significant business risk, significant risk of material misstatement, audit procedures in respect to the investments, data protection issues, non-compliance of laws and regulations. So you can plan easily. Not a big deal, not a very difficult question, and not a very lengthy question. Okay. And you can easily do a lot of things in 15 minutes if you wish. Okay. At least first three requirements. Are you getting this? So it's 9:15. We will resume after 15 minutes. Dear students, I hope you have to manage to plan the pointers of this question. And should we start discussing it? If you are done, should we start discussing it? Dear students, I'm awaiting your confirmation. Okay. So I'm reading it, and we'll be discussing this question. Uh, if you wish to take the pointers out of it, you can, but I'll focus on discussion. Okay. How are you going to extract the relevant information? How are you going to highlight the relevant information? And how can this be a business risk and explanation aspects? Okay. So discussion is the key as you move on through this question. So we know about the requirements that in question number one, requirements are in partner's email. So I'm just going through the external content, the content which is out of exhibits. It is 1st of July. You are a manager in the audit department of 𝗏𝗀𝗃𝗀𝗃 Chartered Certified Accountant, and I told you to highlight the date, which will usually be 1st of July 2x5. When you are responsible for the audit of 𝗦𝗲𝗀𝗃𝗀𝗃, a listed entity and an existing client of your firm. Listed entity, an existing client of your firm. So for existing clients, you can keep the materiality at the upper range, okay? Or you can take the mid range as well. The financial year ending 30th September 2x5. The following exhibits available on the left-hand side of the screen provide relevant information. We know this partner's email, an email which you've received from all your FIG audit engagement partner. Usually, always the first exhibit is the partner's email, then meeting notes. Usually it is the case with all other questions. Notes of a meeting which Olivia Fig recently attended with the audit committee of 𝗏𝗲𝗃𝗏, focusing on understanding the current operation and future strategy of the business. Then you have financial information, which is usually the case that you have some financial numbers in exhibit 3, and then another exhibit to craft the requirement D or C or D requirement, okay? An internet search headline results from an internet search performed by the audit team about the business and industry, okay? So let's read the partner's email. I attended the planning meeting last week with the finance director and a representative of the audit committee of 𝗏𝗏𝗃𝗏, at which we discussed business developments during the year and plans for the future. I have provided you with my notes from this meeting, as well as some background info about the company from the permanent audit file. Based on the analysis I've done on this industry, it's appropriate for overall materiality to be based on PBT. So we have been given the measure for materiality. Evaluate significant business risks. Significant risk of material misstatements. Principal audit procedures in respect of classification of the investment. And then with reference to data protection issue, discuss 𝗏𝗏𝑆co's responsibilities in relation to 𝗏𝗏𝑆co's compliance. So compliance with laws and regulation, the responsibility of the auditor, we have already discussed when we were discussing the theoretical section. This is more of a knowledge-based requirement. But obviously here you are not only required to reproduce the knowledge elements, but you will also be required to link it up with the given information and make your answer juicy, fruity, okay, so that you can get the marks. Mere reproduction of knowledge elements will not fetch you marks or enough marks, okay? So we are going through meeting notes, and I hope you are very attentive during this discussion. Okay. 𝗏𝗏𝘀𝗀𝗏 is a listed company operating as a retailer in the online grocery market with coverage of 75% of the country. So it's good if we highlight their operations. The company has a loyal and growing customer base who place orders via either the company's website or an app which can be installed on customers' mobile phone. Great. 𝗏𝗏𝘀𝗀𝗏 fulfills grocery orders delivering to customers' home via a fleet of company-owned refrigerated vehicles. 𝗏𝗏𝘀𝗀𝗏 prides itself on having a market-leading inventory system. Okay. Perfectly fine. So, okay, there are few very obvious risks, but there are few remote risks as well. Of you, not remote, I would not recommend you to write the remote risks, but whatever information is given, you can easily extract additional business risks, even it is not given in the marking scheme. For example, dealing to via a fleet of company-owned refrigerated vehicles. Okay. So this is an important element. And what if this important element of the business is out of order or fails? You might miss orders, you might miss customers, and you might lose sales. Okay, so even you can write this. That maintenance of these vehicles, uh, proper maintenance of these vehicles, these refrigerated vehicles, the refrigeration, which keeps the grocery intact, that's very important. And if the entity fails to maintain this, then they may face returns. 𝗏𝗏𝘀𝗀𝗏 prides itself on having a market-leading inventory system, another, which ensures that customers can only order groceries which are currently available. This helps 𝗏𝗏𝘀𝗏 customers avoid inconvenience of ordering unavailable items. So, what if this market-leading inventory system stops working? That would be a concern. Okay, so they'll receive wrong orders, they might not be able to fulfill, and the customers may be lost. A significant proportion of the groceries supplied by 𝗏𝗏𝘀𝗀𝗏 are perishable products, the sale and storage of which is highly regulated through food safety regulations. So see, perishable products. Perishable products. So perishable products is itself the business risk. So you can link it up with the refrigerated delivery vehicles. These are perishable products and they need to be kept in refrigeration. If refrigeration doesn't work, the perishable product may be contaminated. Okay, this product may be expired, may get contaminated, may not be any more useful for the customers. The sale and storage of which is highly regulated. See, this is another business risk. If its sales and storage is highly regulated, then the risk of non-compliance. Then comes the risk of non-compliance. If they are unable to follow the food safety regulations, if there are fines, there are penalties, there are vacation of license, loss of customers, payment of penalty. So very similar to what we have already seen. Winberico employs experience in food product technology. Okay, we saw this very similar in the pet care question yesterday. So they also employ experienced food product technology professionals to ensure the company complies with all food safety legislations. So what if the staff is inexperienced, untrained, reckless? Yesterday we also saw that professional staff. The directors of Winberico are pursuing ambitious expansions and plans in order to establish a strong position in the home delivery grocery market and to explore business partnership in associated markets as well. They're also planning to expand themselves. Okay. So whenever there is an expansion, there are risks attached to the expansion. Now let's read the para for expansion and then I'll show you. Winberico is planning to expand in the foreign country of far land by setting up operations similar to its existing business. Not a big deal. Okay, but wait. Whenever it is written that they're going to expand in the foreign country and it's their domain, they are expert, they know they are growing in the similar existing business. Could there be problems? Answer is yes, there could be problems because jurisdiction is different. You are master in your own jurisdiction, you are king in your own jurisdiction. But when the jurisdiction changes, when the boundaries of the country change, there are multiple challenges. It's not about only it's not only about a way of doing business, but there are multiple challenges. You don't have control over the supply chain. There are language barriers. Currency is different. The different political challenges. No one knows you there. You have to establish your name from the scratch. Okay. So you need to get multiple factors right in order to get your business established in another jurisdiction. Okay. So all these are the challenges. What if they don't get an adequate supply chain? What if they fail to follow or they fail to identify the preferences of the customers in the international market? Might be they're not willing to order this product online. Might be there's not the trend there. Might be the regulations might be stricter. Okay. Well, so all these are the elements why this business can fail. So this is a business risk. Expansion in foreign country may fail. Why? All these factors. Foreign uses the same currency as Winbury's coexisting operations. Okay. So currency is same. So don't write currency as a business because currency is same. The investment is expected to cost $125 million. Now see, this is again a business risk. Such a big investment. What if this investment fails? All this amount will be drowned. Burden on your cash flow, burden on your loan liability increases. Suppose, I don't know, we will see. I even not remember what will happen in this question. Might be this could have been financed through a loan, which is usually the case. So we will also be paying interest on it. Okay, again, interest expense goes up, profits goes down, business risk. Gearing goes up, loan covenants need to be met, things like that. Okay. So we know all these factors contribute to business risk. What if go wrong? What if this goes wrong? Winberico does not currently have the funds for this expansion in advanced negotiation with the current bankers. So see, it's in the very next sentence. They're in negotiation with the current bankers who are keen to provide loan financing on the same basis and covenant as the existing loan finance. So covenant as the existing loan finance. So that simply means that if the existing loan, if the covenants are not met, then this entire amount need to be paid back. And if the covenants are deteriorated, so the new loan will also go back, and the old loan will also go back because covenants are similar. For example, there could be interest cover requirement for the old loan as well as the new loan as well. And suppose the interest cover covenant is breached, both loans will go away. Cash flow problem, business continuity problems, business risk. Okay. Data protection issue. 2 months ago, Winbirico suffered a cyber security attack in which the personal information of 2,500 customers, including their credit card sales, was stolen. Such a big blow. According to a representative of the audit committee, the company's internal audit team had not properly assessed the risks relating to cybersecurity, which is a requirement of data protection legislation. So, see, can there be customer claims if their card's details have been lost? There could be misuse of this information and there could be customer claims. Customer claims, penalties, legal case, loss of reputation, loss of customers, business risk, business risk, business risk, business risk. According to a representative of the automotive company, the internal team had not properly assessed the risk related to cybersecurity. So, see, their controls are weak. Their internal controls are weak. Their internal audit team is lame. Their internal audit team is no more effective. Control environment is weak. This itself is a business risk. If controls are weak, it could result in losses. It could result in abnormalities, errors, anomalies gone unnoticed, impacting business profits. Okay, which is a requirement of data protection legislation. Again, now see, the legislation also popped in. So this is a violation of the legislation as well. So business risks against legislation, lots and lots. Penalties, loss of reputation, loss of revocation of license, and things like that. The issue which led to cybersecurity attack has now been resolved. Winbirico did not make any report of the breach to regulators. First, the offense, then not reporting it to the regulator. If it later comes into knowledge of the regulator, this could be a bigger offense. Okay. Penalty could be magnified. Well, so as far as business risks, we've discussed lots and lots and lots of business risks. Okay. In financial information, I've already told you that examiner is now giving this is a regular feature, and all the sub pointers will give you an audit risk easily. A listed company, earnings management will automatically be a pointer. Rest are in front of you. Groceries, increased. Okay, so you can obviously calculate increase and decreases. This is not a big deal for you. Number 1, number 2, 3, 4. Okay, so let's read 1. Groceries. Groceries revenue includes revenue earned for a new initiative launched during the year by Winbury. This guarantees a weekly delivery slot for customers who sign up for a premium delivery pass. The premium delivery pass is an annual membership with a fee of $60. The fee is invoiced in advance and the revenue is recognized in full at the time of invoicing. So don't you remember this is very similar to the yesterday's question where there was annual pet healthcare plan, annual delivery pass, risk of early revenue recognition. Non-compliance of there is a risk of non-compliance of IFRS 15. See, the fee is invoiced and revenue is recognized in advance, full time of invoicing. So this is the non-compliance of IFRS 15 because the performance obligation has not been satisfied. The deliveries have not been made. So risk of overstatement of revenues, understatement of deferred revenue, and very simple risk, obvious risk of material misstatement. Getting this? Then pet goods from LPS Co. Okay, it's $10 million. Winbury Co. has entered into a joint venture with Durian Co. and is investing $30 million in a newly formed company, Luxury Pet Supplies, representing 50% of the capital of the company. The remaining 50% is owned by Durian, a leading national chain of vets and pet goods suppliers. Okay, so they are investing $30 million. So IFRS 11 joint ventures. This standard will be applicable. The remaining 50% of shareholding is owned by Durian Co., a leading national chain of vets and pet goods supplier. The contract behind this investment states that 𝗦𝗲𝘀𝗀𝗃𝗃 Co. and Durian Co. will work together to develop the supply of a range of pet supplies, food, toys, and accessories. The joint venture utilizes the established online presence of 𝗦𝗲𝘀𝗀𝗃 and the distribution network and Durian's existing knowledge of the pet goods supplies market. Both parties will have equal voting rights. Okay, so here you can even take another business risk, that there is a business risk that if the Durian has some bad reputation in any walk of this business, any phase of this business, then that bad reputation can also be attached with 𝗦𝗲𝘀𝗃𝗃. Okay. Both parties have equal voting rights. The net assets with profits to be shared equally. Investment is expected to take place in August 2025. Is expected. So in our year, in our financial year, just before the end of the financial year, this investment is expected. The finance director of 𝗦𝗲𝘀𝗃𝗃 plans to consolidate the results of LPS Co. as subsidiary. Obviously, this is not a subsidiary because they don't have power to control. Yes, they have joint control with Durian Co. Okay. And how can you say that they might have joint control? Yeah, they have equal voting rights. Something written here. Here it's written. So this is the joint venture. They don't have any control. So IFRS 11 is applicable. IFRS 3, this is not a subsidiary. There is no control as per IFRS 10, not a business combination. And therefore, both of the ventures might have to account for their own assets and liabilities and share of investment. Okay. 100% of LPS core revenue from incorporation is shown separately in the financial statements above, going to 𝗦𝗲𝘀𝗃𝗃 Co. Full compliance with IFRS 8. Finance director believes that despite 𝗦𝗲𝘀𝗃𝗃 and Durian Co. each owning 50% and having equal representation, 𝗦𝗲𝘀𝗃𝗃 Co. contribution of knowledge to the joint venture is greater, and therefore 𝗦𝗲𝘀𝗃𝗃 should consolidate the investment. So, in the absence of any additional rights or any additional controlling rights over this investment, 𝗦𝗲𝘃𝗃 cannot simply claim that since we are putting more information, we should be consolidating it. No. Okay. So non-compliances of amounts and what were the figures? Okay. So see this 60. Net assets as consolidated relating to the subsidiary. This is not a property. You cannot identify the net assets. Okay. You can only account for your share of investment, and with the joint operation, your share of profit. That's it. So you should obviously explain the correct accounting treatment and fetch the easy available marks. Then PPE relating to the fire damage power warehouse. Point number 3. In January 2005, there was a fire in one of the 𝗦𝗲𝘀𝗃𝗃 Co. 5 warehouses, which completely destroyed the premises, but fortunately, no staff were injured. The warehouse serviced the northern region of 𝗦𝗲𝘀𝗃𝗃 Co. customer base. Okay. No staff was injured. There was a fire. So initially, what comes in your mind? There was a fire, warehouse, impairment, obviously. The warehouse received the northern region of the 𝗦𝗃𝘃𝗃 Co. customer base. The finance director has not written down the carrying amount of the warehouse in the PPE, as he is confident the company's insurance policy will cover all costs. Rubbish. Insurance matter is a separate matter. Your property burned. with fire. The asset has been impaired. This is event causing impairment. Okay. So first of all, you need to impair this asset. Book the impairment as per IAS 36. Okay. Insurance policy. So IAS 36 requirements. About the impairment. Asset should be valued at lower the carrying value and recoverable amount. This is the event, which is simply giving an indication of impairment. As far as the insurance recovery is concerned, we discussed yesterday in the question of another question which we were looking at yesterday, that insurance claim can only be recognized when it's virtually certain. Otherwise, you cannot recognize it. Okay. The insurance company has confirmed that they will repay Winbury for the inventory loss during the fire. However, the claim for the warehouse, building, and machinery is still ongoing. So, if it is virtually certain, then you can recognize the insurance recovery. If it's not virtually certain, if it's not established yet, you can disclose, but you cannot recognize. Okay. But the claim relating to the building and machinery is still ongoing. There is no conformity. Even if you say that there has been some conformity on the inventory loss, okay, you can recognize it if it's virtually certain. Otherwise, no. Winbury Co. was able to utilize the remaining 4 warehouses to provide the coverage to the northern region customers. Okay. So, 2 risk of material misstatements, IAS 36 and IAS 37, insurance claim. Then come point number 4, long-term borrowing, containing a bank loan to fund the joint venture. The bank issued a loan the same terms as the existing loan, which has a covenant that interest cover is maintained at 3. Okay. So, business risk, number 1, plus the sales has increased a lot. PBT increase, sales increase. Okay. There might be the indication of earnings management as well. They might have inflated their sales. Okay. Listed company inflated their sale, incentive for meeting the covenant, earnings management biasness, risk of material misstatement, plus business risk as well. Okay. What if the covenant is not met and they have to repay the loan all over? Problems for the business. So, are you getting this, dear students? An internet search, non-compliance of laws and regulation is very simple. The Grocery Trade Journal Perishable Planet support the demand for online grocery delivery has reached an all-time high, showing no sign of slowing down. Traditional supermarket cannot afford. Perfect. Leaving opportunities for gains in market share for online operators. Good news for Winbury. But 15th Jan, what has happened? A group of 30 local residents who claim their health was affected by toxic fumes from the huge fire. The fire erupting has disturbed the residents. Bringing action to claim for compensation, the local residents' legal representatives confirmed that they had served a claim against Winbury as they believe that there were health and safety breaches, financial statement risks, IAS 37 implication. Okay, so risk of material misstatement again popping here as well. As long as an investigation is concluded, warehouse staff had manually overridden the automatic sprinkler system to prevent water damage too. Good. Okay, so the water Winbury Health and Safety Department has launched an investigation, and this has been concluded. Eco-friendly vans cause delivery disruption for Winbury. A new fleet of 80 electric vehicles costing 50,000 each has caused delivery kiosks to Winbury for local loyal customers. Vehicle can only travel for 100 miles without requiring recharging, which has left customers experiencing delays of up to 4 hours of the groceries. Eco-friendly vans were initially selected purchased by the management based on suitable delivery range. However, at request of Winbury, manufacturer of the vans adds the refrigeration units to each vehicle, which has significantly reduced the distance the vans can travel on a single battery charge. So what was the question? Let us see again. With reference to data protection issue referred in Exhibit 2. Okay. So that relating to data protection regulation. Okay. So all these elements. Now see here. This one. IS 37 implication plus loss of customers, business risk as well. Loss of customers, loss of revenues. And then IS 37 implication. Simple. Eco-friendly vans cause delivery disruption. Is eco-friendly vans again business risk? You will add the business risk. If it's still remaining and your marking quota is still remaining, we've already discussed too many. Plus, these vans are not performing well, impairment testing in these vans as well. Okay. Because they're not providing you the relevant utility. There's an indication of impairment. Are you getting this? So even these will be impaired. So we have discussed a lot. Even if any risk is remaining, we might have exceeded our marking quota. Now, the last requirement, data protection relating to this. Okay, what was the requirement? Discuss 𝗏𝗏𝘁𝗀𝗃 responsibilities in relation to 𝗏𝗏𝘁𝗀𝗃. 𝗏𝗏𝘁, what is the 𝗏𝗏𝘁 responsibility? Okay, as far as the non-compliance of laws and regulations is concerned, the auditor, number one, auditor is required to know the relevant laws and regulations. Number two, if the non-compliance is identified, what is the impact on the financial statements? Could there be any potential for penalties, obligation, court case, potential outflow? Does it require any disclosure? Does it require any recognition of the amount? It's auditor's responsibility to identify. Plus, if there's a legal non-compliance, so does it require any disclosure to relevant authorities? Does it is this problem in the public interest to disclose? So apparently seems yes, because otherwise, if this information has been leaked, customers may suffer losses. Okay, so confidentiality concerns. So all these elements, laws and regulations, we've already discussed. So this is not a big deal. This is knowledge. This is based on knowledge-based element. And what was the last thing? Principal audit procedure in respect of classification of investment. So during the discussion, we've already discussed classification. There is no control. Okay. So what will be the procedure? For classification of investment. Number one, what is the arrangement document? What are the entitlements? What are the rights? Okay. Are there any preferential rights for 𝗏𝗏𝘁𝗏𝗃? As far as voting rights, do they have any special voting rights? Okay. Board of directors meetings, discussion of directors meetings. Simple. Minutes of the meetings with the joint venture. What is the discussion? What is the arrangement? Are you getting this? Control. Is there any element? Inquire with the management. Why do they think that they have control? Is there anything which establishes their control? So these procedures are very simple. And you can easily score 5, 6, 7 marks. Is this crystal clear to everyone? Is everyone getting this? Please let me know. Please confirm me. Are we on track? Are we on the same page? Please let me know. Great. Okay. We'll take a 5 minute break. Uh, we'll take a break later on. Let's first discuss few things about the non-audit assignments, and then we'll have some break. Okay. As far as the non-audit assignments are concerned, we know what are the usually tested non-audit assignments. Forecasts, business plans, forecast, cash flow forecast, profit forecast, due diligence assignments, forensics assignments, or there could be any social or environmental data for which you may be asked to carry out procedures. Usually, the examiner, whenever the examiner gives such type of questions for non-audit assignments, Part A comprises of acceptance considerations and Part B comprises of the procedures. As far as acceptance considerations are concerned, we have already discussed when we were discussing quality management and ethics. We discussed the acceptance considerations. As far as procedures are concerned, we know the technique to draft the procedures, and we will see here again. As far as the assignments are concerned, business plans, forecast, due diligence, forensics, we'll discuss these one by one and we'll see and we'll discuss few questions. Okay. We know this is not audit, this is non-audit. Assignments, non-audit assignments does not contain audit opinion. So most of the assignments are review assignments. Few are even not review assignments, they are agreed upon procedures. Like due diligence could be a review assignment, means less testing, less assurance, or it could be an agreed upon procedures, which means no assurance. When we say review assurance, review assignments, less assurance, limited assurance, then we give negative opinion. We use negative language and we give negative opinion like nothing has come to our attention. Procedures are also restricted, majorly analytical procedures and inquiries, AE. Okay. This is not as extensive as audit because the fee is not that much as audit. It does not take time as much as audit. Okay. So we place less reliance. We know this acceptance considerations technique for prospective financial information, cash flow forecast, business forecast. Procedures remain the same. But you need to understand what is a revenue forecast and what is the cash flow forecast. Revenue or P&L forecast will include P&L items, non-cash items. These are not cash inflows. These are incomes and expenses. Income and expenses. Okay. Revenues. We'll talk about revenues. We'll talk about accruals. Even the expenses which have not been paid will be forecasted. Cash inflows and outflows will be based on receipt basis. So be very clear. Non-cash expenses like depreciation and impairment will not appear in the cash flow statement. Cash inflows, outflows, but yes, will appear in the profit forecast. Cash flow forecast payment terms will be the key as we will be tracing the payments as per their payment terms. Bad debt will not be an expense in cash flow forecast because we are only recognizing receipts. But yes, in profit forecast, this will be an expense. What are the procedures? Usual procedures, common procedures, mainly analytical procedures and inquiry. We'll be comparing the forecast with actual previous year forecast, with actual this year's forecast, with the actual numbers of 1, 2, 3 months, which have already been passed. And we will see brought forward and carry forward figure. They are aligned. For example, if there has been any brought forward figure in the profit forecast, it should be the actual carry forward figure, okay, in the financial statements. Inquiry, who has prepared these forecasts, why, what assumptions have been used, what data was there. Inquiry, simple inquiries. Other procedures, these are the key procedures in prospective financial information, which the standard has prescribed. Now, what are those? If you are forecasting revenue, and if you have any sales order, confirmed sales order, on the basis of which you are extrapolating this, have these orders reviewed. Check these. Have any orders been received? Or have you any purchase, or have you placed any purchase orders on the basis of which you are showing purchases? Agreed salaries, HR records. Have you placed any orders for advertisement commitments that you can see from there? The outflows, potential outflows, interest charges. Are there any loan agreements in place from which you can trace future, or you can estimate future interest charges? Written representation very necessary. Due diligence exercise and other non-audit assignments where a company is willing to acquire another company. Obviously, they need information, they need some opinion from the auditor. Should we go for it? Give us some assurance, some information about their financial matters, operational matters, market position, commercial terms, legal matters, tax matters, HR matters. So obviously, procedures need to be carried out for these. What are the procedures? Financial performances could be checked with audited financials, current management accounts, future forecasts, customers' contracts. Do they have customers' contracts, firm customer orders, suppliers' commitment? How are they committed? Will they go away if we acquire or not? Key staff period, notice periods. For example, if we acquire the company, will the staff will the staff be retained for at least the notice periods, or will they run away, causing problems for us? Contracts, leases, patents, copyrights approval. Will they be valid? Will they be effective, or will they be cancelled? Okay. Or if we want to cancel, can we cancel it or not? Being a potential acquirer, being a new parent company. Other issues, any legal cases, pending legal cases which can haunt us, reputational issues, laws or regulations soon to change. And this is very important. What will target company lose because current parent will take it back? There could be some free lunches, free IT services, free head office, rent-free head office, which the target company might be enjoying. If we acquire that company, we cannot give these free lunches. We will have to incur cost for it. So be very sure and vigilant that which costs are not apparent, but you will be required to bear those costs, as you have to put it in your budget, isn't it? Or in your decision making analogy, that whether you should go for this investment or not. Social and environmental matters, again, very similar to audit procedures. If you are asked about testing social and environmental parameters, now what are those? Entity is marketing their performance measures, that we are doing so much charity, so much trainings, we are concerned about employees health and safety. Our performance measures, our machine downtime has reduced, we have reached this much efficiency, we are environmentally friendly, less carbon emission. How can you check it? Okay, just think and you can check it. Staff satisfaction, check. Satisfaction surveys, responses, get some surveys done. Recycling of waste, how much waste was produced and how much recycled material has been received, or how much have you billed to the recycling vendors? Go and check it. Carbon emission, check it from the relevant reports. That has it been reduced? Charity, go and check the charity reports. Have they given charity or not? So all these are measurable. How? Through audit procedures. There is nothing new. Advising the company on key performance metrics is employee turnover, person satisfaction, survey results, donations, as I already discussed. Go and check those documents. Procedures may include assessing whether related costs, cleanup, alteration, or when asset, if you are claiming that you have made the product greener, trace those relevant costs. Have you expensed them out for an assets? So assessing environmental provisions and contingencies. Now, these have been some financial impacts as well. Assessing whether new environmental regulation means that some assets have been impaired. Assets impairment. Okay. And last but not the least, forensics. Any investigation which may be involving any fraud event, and you might have been asked to help the entity out in sorting out the problem, identifying the fraud, quantifying the fraud, identifying the issue. You may be required to present in court case. So this is forensics audit is something problemsome exercise. Okay. This is nothing but audit in the greater detail. You make detailed scrutiny. Audit in greater detail. That's it. All audit procedures will be applicable. This could involve fraud implications. So all fraud related procedures, legal implications, you may be required to present in court of law. Absolute confidentiality. You can disclose absolutely nothing to anyone. Here, the confidentiality principles are at the peak. Zero materiality. You might have to check every transaction, all data. Third party disclaimer. And whenever if you issue any report, it will put a disclaimer that this report is intended for this person, not for this person. And usually forensics audits are agreed upon procedures. Okay. So you might be asked about procedures. So writing forensic procedures is easiest thing because the same methodology, same uh, technique as you're using for audit procedures will be applicable here. Okay. So I hope now you have an idea about the non-audit procedures, and let's see which are the ones which are favorite for the examiner. Okay, let's read the requirement. Evaluate the assumptions used by management. Okay, so whenever you are evaluating a cash flow forecast, profit forecast, obviously the assumptions are very important. If assumptions are not realistic, superfluous assumption, not based on any ground realities or at least believable realities, then you may say that these forecasts does not give true and fair view because you are at last giving opinion. So you can say these does not give true and fair view. These are not adequate. Okay, assumptions are very important. So the validity of assumption should be checked. If the given information is contradicting with the if the given parameter if the given situation given condition is contradicting with the forecast numbers, there's a problem. Or the management says that although currently sales are increasing by 1-2%, but in the next year we're going to increase it by 20%, 30%, 40%. How? Why? No logical reason. Superfluous assumptions. We have to challenge those assumptions. Okay. So evaluate the assumptions used by management and completeness of the cash flow prepared, 10 marks. So you have to test every assumption, be it revenue, be it cost, be it tax, be it expenses, be it salaries. The information might have been given to you, or at least the numbers might have given to you. Explain the audit evidence in respect of cash receipts. So audit evidence. You are champion in audit evidence. For future sales order, see, have you received any sales order? For future purchases, see, have you any contracts, any campaigns, any purchase orders which you already placed? Salaries from HR records. Taxes, whatever the tax rate is applicable. So this is not a big deal. So just go through this question. I'm giving you 5 minutes, 5 minutes to 6 minutes, and then we will discuss this. Okay. Dear students, I hope you have read this question. And the approach remains very simple. If you have to evaluate the assumptions used by the management, you have to simply think and think critically. Because here are the marks for professional skepticism and action, professional skepticism and judgment. How can you ask questions? Why? Because the question will tell you that this the management says like this. Now you have to question them. Why? You have to primarily make the inquiries, assumptions. How? Why? How? Why? How? Why? Okay. Evaluating the assumptions used by management and the completeness of the cash flow forecast. Completeness of the cash flow forecast. Is it complete? Is it complete? Is there any expense missing? For example, is the loan interest expense missing? For example, is the salary expense missing? Okay. And then you have to explain the audit evidence in respect of cash receipt. So you are champion already in audit evidence. So that's not a big deal. Okay. So it is 1st of July 2005. You are an audit manager in 𝗥𝗲𝗃𝗀𝗃 working the audit of 𝗥𝗲𝗃𝗀𝗃𝗀, book and magazine publisher. 𝗥𝗲𝗃𝗀𝗃𝗀𝗃 has a financial year ended 31st March 2005. So you are after the year end, you are standing after the year end. You are standing on 1st July 2005 and the year has already ended on 31st March 2005. And you are reviewing the work performed on going concern. So, as part of the work performed on going concern, you are looking at the cash flow forecast. You are, though you are not giving the opinion, but as part of your going concern assessment, you are working cash flow. The following exhibits available on the left-hand side of the screen provide information relevant to the question. Oh, goodness. So, was this screen stuck earlier as well? You should have raised this concern earlier, Burton. I was assuming. Okay, unfortunately. Okay, so let's start. So, although you might have been listening to me, so the question is on your screens now, unfortunately. The screen was stuck. The following exhibits available on the left hand side of the screen. Okay, sorry. So, 𝗥𝗲𝗃𝗀𝗃𝗀𝗃 has a financial year ended 31st March 2005, and you are reviewing the work performed on the going concern. Following exhibits available on the left hand side of the screen provide information relevant to the question. Audit file notes a summary of audit working papers relevant to the going concern. So, as I told you, so you are reviewing this cash flow forecast as your audit procedure ongoing concern assessment. You are not reviewing it. But even if the question comes up for a cash flow forecast and you are reviewing it, you will be analyzing it with the same pattern, same mindset, same thoughts. Okay. Your professional judgment and acumen will not vary. You will you will approach that information with the same approach. Cash flow forecast, a cash flow forecast covering period to 31st March 2x7. That means next 2 years. Information should be used to answer the question requirement within your chosen response options. Perfectly fine. Audit file notes. Okay, so what are the notes? So see, there will be lots of discussion going on, and obviously we need to challenge that discussion. And here is the cash flow forecast. Okay. Okay. So audit working paper prepared by an auditor, going concern issues highlighted, date. The audit work indicates that there are significant operating and financial problems facing the company. The management has prepared a cash flow forecast, which they believe should provide evidence that 𝗥𝗲𝗃𝗀𝗃𝗀𝗃 is a going concern. 𝗔𝗲𝗃𝗀𝗃𝗀𝗃 business is significantly impacted by an industry-wide deterioration in demand for printed books and magazines. The company had recently acquired a digital publishing business at a cost of $25 million, and management is confident that 𝗔𝗲𝗃𝗀𝗃 will soon be able to offer a broad range of digital books and magazines. Okay, so if we are keeping both the requirements in mind, evidences and testing of assumptions. So the acquisition of the digital publishing business at a cost of $25 million, this should have been tested as an evidence, okay? And management is confident that 𝗔𝗲𝗃𝗀𝗃 will soon be able to offer a broad range of digital books and magazines, okay? Now see, management is confident, okay? Promptly you should say or ask, why management is confident? Are there any established patterns? Or are there any statistics that digital books or magazines have a very big market, or their customers are very techy customers? Or if so, there should be associated expenses. Have they accounted for those expenses? However, authors of printed books will need to give consent for their books to be converted to a digital format. Consent. So again, as an audit evidence, you will put it in the planning point as consent. You should have the copy of the consent. But management assumptions will inquiry with the management. Will the authors be willing to give their consent? They have assumed that they will give the consent. If we have thus this revenue is projected. Why? Or have there any discussions made? Copy of those discussions. Authors are paid royalties based on their sales of their books, typically around 5% of the revenue generated from their titles. There is a concern that due to company's cash position, there may be delays in making royalty payments to some authors. Okay, so you can recalculate the royalties. Okay, the cash receipts from customers, cash receipt from sale of Happy Travel range, operating expenses, interest payments, loan repayments. Okay, let's read it and then we will go on it. Authors are paid royalties again. So, as an evidence, we can take their contracts. Evidence. Part B is about evidence. So, we can take the contracts. Authors are paid 5% of the revenue generated from the title. So, is this fixed percentage? There is a concern that due to company's cash position, there may be delays in making royalty payments to some authors. Okay. So if that could be there could be the delay. Have this delay been projected in the forecasted statement? You will see it. In addition, the rapid growth of online retailers have impacted negatively on company sales, as 𝗔𝗲𝗃𝗀𝗃 has not until recently developed marketing resources to engagement with online retailers. Analytical procedures show that revenue has declined by 20% this year, accelerating the trend seen in previous year. Again, has not until recently devoted marketing resource to engagement with online retailers. Analytical procedures show that revenue has declined by 20% this year, accelerating the trend seen in previous years. So this year, the revenue has declined more. In the financial years ended, the revenue fell by 10%, 12%, but this time it has accelerated more, 20%. Okay. So they have not devoted any marketing resources, but can we have any copy of the discussions with the retailers as an evidence? As an evidence, can we have any correspondence inspected copy? Okay. The company has recently contracted a very popular author to write a series of 3 children's books. Author Chandler Muriel, who has sold millions of books worldwide, has delivered the first book in the series. So, what is the contract? When will it be delivered? In evidence section, which was published in Jan 2X5. Sales of the book since its publication have been disappointing at only $135,000. Management explained that this is due to rival company publishing a similar book in December 2X5. Chandler Muriel's second book is due to publish and third in. So, again, what is the management's assumption? Will this sale increase? What if the second book suffers the same setback as the first book? Question. Financial issues. 𝗔𝗲𝗃𝗀𝗀𝗶cie faces a liquidity problem, having only 78,000 of cash at 31st March. The company has an overdraft facility and in addition, agreed undrawn borrowing facilities of 1 million. There is also an existing 5 million unsecured bank loan which is due for repayment on 30th September. Again, whatever forecast you're looking at, you need to see that whether all these elements have been incorporated in the forecast or not. Okay. Company has an overdraft facility. Is it shown the payment or the forecast facility? The interest relating to these, is it shown? The due for repayment, $5 million due for repayment in September 2X5. Can we see the repayment? Let's see. Due for repayment on 30th September 2X5. See, the loan repayment is shown in 30th September 2X6. As I told you, the elements will not be corresponding with the given information. So this is what the disconnect you need to identify. Are you getting this? And then you will question assumption. How? Why? Why? This is not right. This is questionable. Disclosure relating going concern. Management has confirmed that they will provide full details of the going concern. Okay, and one more thing, interest payments. Can you see the interest payments? See? Yes, there are interest payments, but how can these interest payments be uniform? Because the company has an overdraft facility of $250,000. In addition, agreed undrawn borrowing facilities of $1 million. Obviously, those will also be utilized. So, does the forecast contain the interest element of these undrawn facilities which will be drawn in future? Disclosure relating to going concern. Management has confirmed that they will provide full details of the going concern issues facing 𝗔𝗲𝗃𝗀𝗀𝗃 in the notes to the financial statements. Happy Travels Publishing Range. 𝗔𝗲𝗃𝗀𝗀𝗃 has made that about this. They will give the disclosure in the financial statements. That's it. Simple. But we are looking at the forecast. Happy Travels Publishing Range. 𝗔𝗲𝗃𝗀𝗀𝗃 has made the decision to sell its popular Happy Travel range. This is the range of books aimed to students, traveler, and include maps as well as suggested hotels, activities, and 𝗔𝗲𝗃𝗀𝗀𝗃 anticipates significant interest in the range with a sale expected in Jan 2X6. Sale expected in Jan 2X6. So has there been any correspondence? What could be the expected sale value, recovery? Why the management believes if there is any significant recovery. Okay, now let's see the cash flow forecast. See this sale of Happy Travel range. How have they arrived at this figure? What's their working? What are their assumptions? Documents, meet minutes if they have discussion minutes and director minutes, minutes of directors meetings. Obviously, and that's it. Okay, so cash flow forecast, cash receipts from customers, cash receipt from sale of Happy Travel range, you already discussed. Operating expenses, Okay, the operating expenses seem to be on a steady range. There is a note on that. Interest payment, we've already discussed. Loan repayment, there is a note on that. Monthly sales are based on management forecast, which predicts sales growth of 2% in each 6-month period. The sale growth is anticipated based on several assumptions, including that a full range of digital books and magazines will be available from 1st of August. 1st of August. How could this be available that quickly? The contract with the authors are not yet finalized. And that closer connection with the online retailers will drive an increase in sales. Has there been any correspondence? In addition, management assumes that sale from Chandler Memorial book will generate income of approximately $250,000 per 6-month period. On the basis, previous books suffered a setback. How can you say this? It so we will be inquiring from the management. Okay, management has recently decided. We've already discussed this royalty related element. We've already discussed and a $5 million payment. They're in the negotiation. They're in negotiation. So again, what are the assumptions? Have banks shown any soft corner? Have they been current on meeting their covenants so that the bank gives them the favor? So you have to basically think professional skepticism. Question, put a question. Why? How? How is it possible? What will be the basis? Is it reasonable or not? Cash flow profit forecast will follow the same pattern. Okay. And the rest of the assignments as well, we discussed. The audit procedures are very easy. Procedures for non-audit assignments, very similar to the audit procedures, not a big deal. Dear students, are you having the idea? Are you having the flavor? Please let me know. Okay. So, I would like to thank all of you. We've discussed few questions. Question number one, audit reporting question, non-audit assignment, this question. We've discussed concepts a lot. So now we are reaching the end of these sessions. Okay. So few last moment advices or final advices. So you should be very much focused and concentrated on what I'm saying. We discussed a lot of things. Thank you for being a very nice audience. Thank you for being a very involved audience. But if you really pass this paper, you have to actually practice these questions on your own. You have to actually apply these techniques which we have been discussing. At least you should be attempting 3 exam simulations on your own. Are you getting? Please do attempt the papers. Until and unless you actually attempt these papers, you might not be having the exam focused preparation. You might not be ready for exams. Practice is the key. You have lots and lots of material. Study hub material, these slides, study text, solutions of every attempt. It's not a big deal. Big deal is this engine. This engine should work. This brain should work. You should generate responses. You should be able to write responses. Are you getting this? Please do exam simulations. Please have a thorough revision. Please practice at your maximum strength. Okay. So thank you so very much, dear students. I hope and I pray that you prepare to the best and you pass this paper in this attempt. Thank you very much for attending these sessions. Lots of prayers for you, lots of best wishes and good luck for you. Take care a lot. May Almighty bless you all. Remember me in your prayers as well. Thank you so much. Get you to signing off. Bye bye.